Use high volatility as an opportunity. Hi everyone, my name is Tan and I'm an independent certified financial planner practitioner at Tan Wealth Management. Today, I spoke with Thomas Vakar, senior reporter at KTVU, about how investors can respond to stock market uncertainty. My key message: use high volatility as an opportunity. Consider Roth conversion as qualified distribution from Roth accounts are tax-free. Sell investment at a loss to realize capital loss, which can offset capital gains and up to $3,000 of earned income. Give assets strategically to beneficiaries to reduce the taxable estate. Rebalance our asset allocation to stay aligned with our long-term goals. Stay invested because no one can predict the future. I also share a powerful investing insight. If we invest constantly over 40 years, more than half of the final portfolio value comes from the first 10 years of investing. This principle holds true across different rates of return. Here's a feature moment from our conversation as seen in the KTVU segment.
Certified financial advisor Phan, who owns Bay Area-based Tan Wealth Management, says no one should stop contributing to such accounts, especially 401ks and IRAs.
If you would contribute for 40 years, more than half of the account balance in the end of the 40 years comes from the first 10 years.
And in fact, says Ted, if you have some extra investment cash, now is probably a very, very good time to buy while stock prices are so low. Tom Vakar, KTVU Fox 2 News.
Yeah, the losses, though, really piling up for a lot of folks. Yeah. Tom, thank you for that.
I love numbers because they're unbiased, universal, and verifiable. Anyone can check the math. Let's break down the investing insight I shared in the KTVU segment. Over a 40-year period, the first 10 years of investing can generate more than half of our total account value. Let's explore 3 investing scenarios, all assuming an 8% annual return. Scenario 1. At an 8% annual return, we contributed $10,000 per year at the beginning of the year for 40 years. By the end of the 40th year, the account grew to $2,797,810. This highlights the long-term power of consistency and discipline in investing. Scenario 2. At an 8% annual return, we contributed $10,000 per year at the beginning of the year for the first 10 years. Then no contribution. The funds remain invested and continue to grow at an 8% annual return. By the end of the 40th year, the account grew to $1,574,352. $1,574,352 divided by $2,797,810 equals 56.27%. More than half of the total 40 years value came from just the first 10 years of investing. This scenario demonstrates how starting early allows compound growth to work in our favor, even without continued contribution. Scenario 3. At an 8% annual return, no contribution for 10 years, then $10,000 per year at the beginning of the year for 30 years. By the end of the 40th year, the account grew to $1,223,459. Even though we contribute more than in scenario 2, the delay starts lead to a lower ending balance, highlighting the cost of waiting to invest. The takeaway: time is one of the most powerful tools for building wealth. Starting early, even with smaller contribution, can have a greater impact than starting later with more money. The earlier we invest, the more we benefit from the power of compounding. I hope you enjoyed this video, and thank you for watching. Until next time, this is Tan, your trusted advisor.